Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Stuart Katz, Chief Investment Officer, Robertson Stephens, to discuss if performance of large cap tech can hold up in the longer term. It's great to see you as always, Stuart. Welcome back to Trade Talks.
Jill, thanks for having me.
All right, you got it. Let's talk about the macro first. What's your assessment of the markets right now?
Let me answer that from the perspective that all risk markets are priced relative to the risk-free rate of U.S. Treasuries. However, today's challenge is that there are cross currents impacting the direction of the risk-free rate in the near and medium term. And the most obvious piece of uncertainty is the debt ceiling debate, but more specifically, there are factors that it could impact raising rates, including sticky inflation, tight labor market, resilient consumer, and other global central banks raising their own rates, creating competition for U.S. money. So the other side of this coin is that there are currents which may pressure rates going down, including the bank instability that we've been experiencing, loan officer surveys showing tighter credit, the Fed shrinking its balance sheet, and the fear of commercial real estate tsunami. So there's this push and pull, these cross currents that exist, which make the direction of travel in the near term uncertain, but we think over 2024 and certainly 2025, the path of rates is coming down. The impact and consequence of all of that, we think basically central banks are unlikely to cut inflation fighting hikes in the near term. Corporate earnings growth will continue to compress and slow down, and we're going to see an economic slowdown eventually, and that for us means a recession, but not a meaningful one.
Stuart, you mentioned you don't anticipate rate cuts in 2023. Can you share any historical context to that?
Yeah, history tells us be careful of what you ask for. Not all rate cuts are the same, and the context around the cut will impact the probability of a risk on or a risk off attitude. So since 1970, there have been 12 rate cuts after the last hike. And on average, it's been about 6 months from the time of the last hike to the first rate cut. So while 2 months from the last rate hike to the first cut is clearly, it's happened before, where it has happened, it's happened in situations, though, where it's been a risk-off situation. Stock market crash in 1987, banking industry stress in the 1980s, a recession in the midst of one of the greatest interest rate spikes of all time in the late 70s and early 80s. And then some of the blunders that Fed Chair Burns had during the 70s at the time when there was issues going on with President Nixon resigning. So the context of rate cuts happening shortly after the last hike is not an encouraging one. I believe it's possible the Fed uses one of its tools before year end and beyond, if you would, just the idea of rate cuts, the tool of Fed speak. And we think they will verbally communicate the possibility of a pivot, but we don't really see that pivot happening in 2023.
Large cap tech has been a strong performer year to date. Do you think that performance can continue?
First, many large cap tech stocks were down a lot last year. So their valuations were more reasonable earlier in this year. The changing interest rate outlook has provided a helpful tailwind as the Fed is perceived to pause and cut. This provides a boost to long-term duration assets, including many of the large tech stocks that you referenced. And let's not forget and ignore the rise of AI. Clearly a factor driving the enthusiasm for the tech sector. Earlier this year, ChatGPT became the fastest growing consumer app in history. And beyond that, you have to look at these companies sort of one by one. And many of them are showing cost-cutting discipline, including Microsoft, which announced that they would lay off 10,000 employees, which is about 5% of their workforce. So these large cap tech companies are showing a focus on profit margins, and that impacts obviously cash flow conversion. So an unintended consequence of this recent big tech success has basically been index concentration, where names like Apple and Microsoft alone now account for over 13% of the S&P 500, the highest level on record, and about 10 big tech stocks account for almost 100% of that index, meaning like 490 of them are flat or down. So the profitability aspects of this are critically important. But one area of concern we have around this large cap tech is the absence of any robust top line revenue growth. So that concern, we think, can impact and focus investors on valuations, which are very high relative to history. So the opportunity, we think, exists in certain large cap tech, but let's not forget that there are certain geographies like European stocks, which are outpacing US stocks for the first time in many years. And there are also other types of high quality dividend paying stocks, which have under the hood, maybe some growth oriented dynamics to them. So I would say in some, it's interesting time for long-term investors to be in both public and private markets thinking about technology.
All right, Stuart, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.